Hello and welcome to NDTV Profit. You're watching Earnings Edge and we have with us PB Balaji, who is the Group CFO at Tata Motors. Balaji, interesting times, too much happening globally in terms of tariffs, US, China, India, UK and now India, US. And in middle of that, I think both the businesses are now net debt free. How do you sum up the quarter and the year for Tata Motors?
Thank you. Firstly, thanks for having me on the show. The year has been a very good year for us. It was a challenging year. It was not an easy year. And also it is a year where the comparator was pretty strong. We had a very strong FY24. It was a record year. So that way I'm pleased that be it on the revenue side or on the profit side, we beat last year in this kind of an environment. Why that's important was that it tells you the underlying fundamentals of the business are doing well. And yes, there may be operating challenges on a growth level, which we will deal with, but intrinsically we're in a good place. That's an important part of the turnaround, that you'll need to deliver a resilient performance under all conditions. And that's also the reason why we also declare a dividend of 6 rupees per share. It's a sign of confidence that we can, because last year the ordinary dividend was $3, the special dividend was 3 rupees. And this year you've taken a final dividend ordinary at 6 rupees, which is a sign of confidence that we can sustain this performance, number one. And at the same time, the external conditions are a bit unclear and challenging at the same time. Challenging means we can start executing strategies. It's unclear. We don't know which way it's going to go. So we just need to wait for much more clarity to emerge before we can move. And if you take the US-UK tariffs, yes, it's a great, finally it happened. But we shouldn't forget that it's 2.5% tariff that's gone to 10%. 25 maybe have come down to 10, but 2.5 has gone to 10. So we still need to ensure that we keep our house in order, do our disciplined cost execution, cash execution, choose the right pockets of growth, ensure where inevitably we need to put up pricing. All that we'll have to take care. At the same time, there is also, we don't know that it's going to be retrospectively applicable from April 3rd. We don't know that it's applicable for parts and accessories. There are a lot of unanswered questions on that, which I'm sure will emerge in the coming days. So that is one part of it. If you take UK-India, that's again, it's an excellent development there because it augurs well for the future. My current cars are anyway all locally CKD manufactured, barring the Defender, and therefore it won't impact the current cars that are already there. But when I look for future cars, that we should be able to get it into the market faster at global prices. But here again, we need clarity on what are the quotas, what are the speed at which the 100% goes to 10%. So we need more details, which I'm sure will emerge in the coming days. And that's why we are dealing with a strong delivery. At the same time, we need to deal with these uncertainties as well.
How do you look at FY26 in this scenario? Means are you penciling in a growth, or at least a growth over FY25, or is it going to be a strong, robust growth with respect to volumes and value coming in?
See, firstly, I think one thing we have been very clear is that we never run the business for a quarter or for a year.
That's why I asked FY26.
So we always position the whole business at all points in time in the right direction. So for us, the fact that investments continue apace should give you enough and more indication that we are absolutely feet on the pedal when it comes to the growth agenda and the investment agenda. What we are conscious of is that I think we need to get tighter with respect to our cost and cash agenda so that we can navigate whatever noise comes on this front. At the same time, we should be clear that we'll have to be super agile. Wherever pockets of growth emerge, you'll have to go and be able to tap into it and deliver on that. Which I think Tata Motors has more than adequately demonstrated the ability to move things with speed and with agility. That we will continue to execute that way. And the demerger just gives us that additional ability to drive focus on the CV side and the PV side much better.
I was coming to that because, that's a domestic factor which is going to play out over the next 2 to 3 quarters, which is there. And how do you see both the businesses now placed now that they would be independent maybe from October onwards?
So I think firstly they're in a very good place, both the businesses. The fact that you got net debt free also is a huge relief for both the businesses, because we shouldn't forget there's almost a 4,000, 5,000 crores buffer that has got created if you go back to earlier era to where we are now, which gives us the flex if we have to flex the P&L. At the same time, if you look at the CV business, let's take one at a time. Barring the small commercial vehicle business, I think every part of the business is firing very well. And this is a year where we hit the 12% EBITDA margin. We grew margins when our revenues declined, which haven't happened in CV for the last 25 years. That business delivers a ROCE of almost 40%. It's a rock-solid business where the market shares of the heavies, the intermediates, the buses are all in a very, very good place. And the realizations are stepping up, profitability is stepping up, and we are able to now deliver value there at a very strong ROCE. So that business, when it demerges and then becomes a standalone business on its own right, it's got a very, very strong cash generation potential, which it's been demonstrating. And we would want to keep that going on that front and use that to go deeper on all other aspects of the business. I think when we crack the small commercial vehicle business, which we are confident we'll do it this year, I think that will also give you higher returns in that business going forward. So CV in a good place, be it the balance sheet, be it the shares, be it the profitability, cash flows, any metric that you take, that's in a good place. CV cycle, let it turn, let it come whenever it comes. It doesn't matter, because anyway we are stepping up our cash flows and profitability even in a down cycle. So it's only upside from here on, from that perspective. Passenger vehicle side, I think last year was a year of consolidation where we did about 13.2% share. And the thing that we should have done a better job of is on service, where the growth came in so fast over the last 4 years. The service requirement was way ahead of what our capacity to serve was. That has got fixed in the last 6 months. Another 3 more months, we should get this completely nailed down. Then you have the product offensive coming in. If you look at last year, SUVs we did well. The only product category that went down for us was the hatches. Tiago has been relaunched. Altroz has been relaunched just now. With that, we would expect to see that come back again. And we then have the Harrier EV launching in, the Punch MC coming in, Sierra coming in. So there is enough and more products for us to. Our product offensive is from competition was last year. For us, it is this year. This combination should help us deliver growth on the PV side. EV side, the only area where we lost out was the fleet segment, which is again FAME 2 incentives went away. A few of the EV fleet players had challenges in their own. That is something we need to attack. There is a substantial CNG segment out there in the fleet side. We are clearly looking at products that can go and cater to that segment, and you should see that play out in the course of this year. So if I say when the demerger happened, that business is already cash positive, and it has a task on hand to pick up another 100-200 bips of profitability on the EBITDA side, which it will deliver the course of this year. Shares going up, profitability going up, balance sheet remaining strong. The PV business, and it is now cash positive, the entire PV business, no challenges there. That should take care of, it can stand on its own legs. And JLR, we have consciously said all the capex will be funded out of operating cash flows, even in this environment. So we are having a good upside coming through as far as the PV side is concerned, despite the tariffs, despite the global environment, despite EV competition, everything laying out there. So even if I look at assuming this year, what we see right now is the worst of times for JLR and PV, you are still delivering these kind of numbers. So the upside is only from here on. So we have enough in our kitty to give us sound confident. The only reason we said, okay, the next obvious question is, why would I not put a guidance on top of all this? I'm sure your eyes were popping out on that. I'm not surprised. If we have always said whatever guidance we put, it needs to be credible and we should hold ourselves to account. You tell me how will I put a guidance and I don't even know whether the tariff is effective retrospectively or not. Mathematically, I can't put it. So let it come through. We have said, okay, hopefully we'll get clarity by the investor day. The minute we get clarity, we'll put it out there, because it also helps us to go for it.
One question on the passenger vehicle side specifically, you spoke about that the service was one thing that you focused on last year, and I think the last time we spoke to you after Q4 of FY24, you mentioned that you were expecting a 3 to 5% industry growth, and that panned out. But for you specifically, the growth was negative for FY25. You mentioned almost 4 to 6 new launches, some going into petrol, a couple of refreshes. Yeah. But in FY25, it was a year of recalibration. Was that something that from the onset was the plan? Because we've seen one of your closest competitors take market share this year, while the other industry players have also suffered. I think the expectation from Tata Motors from FY24 was industry growth. So how would you tackle that question? Because it's a fall in sales essentially in this month at a time where you've planned so much in FY26. The refresh is also a couple of years. So in terms of planning, how has that happened between the last year and this year?
See, last year the thing that did not work in our favor were two things. One was the hatches segment, where we lost substantially more than what we should have lost, because we grew much lesser than the market. And the second was the fleet segment sales error. SUV segment, we are in a good place, and that continues to do well for us. I think the hatches segment, we didn't realize the weakness of the product range till the relaunch happened. Once the relaunch happened, Tiago is coming back into the equation quite nicely, so we should get that picked up. Maybe the fade was simply too sharp on that side. Look at the EV segment, the FAME incentive-led fleet sales. I think that was beyond, it's just a nature of the market. Our market structures was like that because the Tigor EV did not work at all last year because of the fleet segment sales. That is quite a substantial portion of it. But the rest of it have done well for us. And I think with the stabilization of the battery prices and the put-on prices therefore stabilizing, we should expect to see a more sensible portfolio. If I have a one product launch, then the pricing I can do whatever I want. If I have a full range of products that are already in the market, for me to intervene in one price also means that I have to take the full piano has to be worked with. That took us a little bit more, it was more challenging than what we thought it would be. But as we get into this year, battery prices having stabilized, we are on a good wicket on that side. And we've also now got flex in terms of the range of battery packs that we can put onto it. So all this is going to give us the benefit as we go forward. Add on top of it the PLI benefits that are coming in. That gives us ammunition to actually play this much better than what we could last year, because the PLI benefits came in only by Q3. So Q4 has been a decent play, but the losses that we suffered in Q1 and Q2 took us a while for us to recover from. But that I'm confident from here on we should get that right. And internally also, we had such a rollicking growth for the last 4 years. Your systems, processes, business planning, everything also works in one direction. You needed to correct a few things. We have used this time, that's the reason the year of consolidation, we have used that to fix some of the internal processes that were a bit off kilter in this kind of a growth environment.
Would you also say that last year you mentioned 3 to 5% growth for the industry? Is that analysis again for FY26? And do you expect Tata Motors to outperform comparatively? I know you can't quantify, but significantly anything that you can share?
We are absolutely clear that this is a year where we'll go significantly higher than the market. And it is backed by product launches and the fact that the service network has been fixed. Those were the bleeders for me last year. So having fixed that, I should get the kicker this year, with competition also now more or less finishing off their product launches the way their plans are.
You know, FY25 at 13.2% market share. So do you see that market share going up in FY26?
Absolutely. It's a growth plan, share growth plan is what we are currently working with.
So with new launches, the marketing cost also would be something to look at. How would that, because in this year we've seen the margins also drop a bit, and I'm sure that your expectations would also be to grow that substantially from...
See, more than the FME, that was the product, the costs came down because of pricing actions that we had to do and correct for inventories that were already there in the market. I think that is now behind us now, and whatever FME you will get, if your contribution margins are strong, FME can be funded, and those corrections have also been done. So I'm confident we'll get the share increase and the double-digit EBITDA that we have been guiding for. That should be very much the plan for the current year.
How do you look at the JLR as a operation? Because you said that it's now cash. You're going to fund everything from the cash flows for JLR. What is the kind of pipeline that you have for JLR, and what is the capex plan that you have for the JLR?
See, the main launches that are coming up are the Range Rover Electric. Then you have the Range Rover Sport Electric coming through. Then we have the full Jaguar, the new world of electric Jaguar starting to come through. So the next 3 years is a super intense launch phase for JLR. And we start with the Defender Octa that is just about getting launched at this point in time. So for that, the capex plan is about 3.8 billion is what we have guided the business. Last year we did about 3.8 billion of investment. That will be broadly in the same ballpark range this year as well. And that should be funded by the operating cash flows of JLR, even in the worst of times.
Two key markets that you have, one is China and one is US. 34% coming from US for you, and I think Defender is coming out of Slovakia where the rates are much higher. How do you plan to manage that kind of, and is there a way you can shift production to UK or any other market?
No, in the short term we'll not be able to shift production from there to here. So we'll have to deal with it as one of the cost elevators that's going up, for which the source of funds will need to come out of warranties, out of material costs, out of how we sell better mix. And that's the whole transformation program that has been drawn up, which we shared briefly yesterday. And we'll talk about it in greater detail on 16th. The intention is to create a kitty of costs and cash which will help us offset these numbers that are coming through. The question is how fast can we execute them, how much of it will land in year, in quarter, and how much of it is going to spill over into next year. So obviously the teams are on message to say that we do it as fast as possible.
The expectation was that maybe at the end of FY25 you will show us a pro forma P&L of how CV is going to look and how PV is going to look. Will that be also something which you will be showcasing?
CVPV, we already guided the CVPV, no changes as far.
The P&L point is for the markets to understand how both business individually looking in terms of.
See, what the P&L side we already guided for. We have said CV is going to be a double-digit EBITDA business, growing share, and the and it will continue to be a very strong ROCE business. So that has been guided. We stick to that. No change in that. PV business, you said the first port of call is to hit the 10% EBITDA margin. And that is something we fell short of this year. We should have hit it this year, but we are down from that perspective. We want to get back to the 10% EBITDA and grow share in that business. The most important thing metric market is looking for in PV will be continued share growth and continuing to drive EV penetration in our portfolio and delivering a 10% EBITDA on the PV side. PLI benefits are a given, so that will continue to play out. You put this together, the PV business is cash positive despite investments in the EV side. That is how we want to play this part of the portfolio. JLR, we are not in a position to put a EBIT number there simply because too confusing, as we just said. But we are clear whatever capex they require, no pullback of capex, that will get funded by operating cash flows. So that gives you the framework on which to hold the business responsibly. And then everything else that we are able to deliver flawlessly is upside to this case. So we are at least drawing the line in terms of where this business can't go below. And now the question is, what do we do on the upside?
You mentioned that last year was a very good year for you in the US, like roughly about 1.2 lakh units sold. That might be a little bit under pressure this year. I think if anything that you can talk about that. And second was in terms of JLR, because your Defender is a very strong brand and that's been growing very well in India as well, in the US as well. So the other regions which you have, because UK and Europe, you spoke about a little bit that the growth has been slower and you are expecting that to come back in next year. But the other regions, if you can talk a little bit about that, is that where do you target that? Because essentially the growth has to come. I think that would be something to watch out for, right?
See, the markets that are starting to do well for us is now UK is coming back very strong. The reason it's coming back was that last year was impacted by the insurance issues that we had, the theft issues that were there. That's all now completely cleaned out. So the cancellations are collapsing there. So we are in a good place on the order pickup on the UK side. So UK will be the top performer that we would want to focus on, where any volume risk coming out of US, we will want to pick up there. We will want to hold China steady because I think China, we have done very well compared to competition in that market, and that's the reason that we are amongst the only few OEMs which delivered on our guidance and did not drop our guidance at all this year. We held it, and despite market disbelief, we have delivered on that. That is because China is an area that we have played our cards very well, learning from our experience in 2019. That was a challenge there. If I hold China and whatever US volume pressure comes through, I first want to absorb it in the UK. Europe is starting to grow back again. It's starting to gradually come back for us again. And that is something we'll want to incubate and do it carefully. The upsides are all sitting in the rest of the world, where Middle East is doing well for us. India is doing well for us. We'll want to see how much we can pick up on the slack that's coming from the UK, from the US onto these markets. So a little bit of remix of demand, strong focus on cost and cash, then the full portfolio will be able to hold it together and say that how do you grow from here on, both on the profit side as well as on the growth side. But that will require us a little bit more time for us to work the whole problem out.
Balaji, we are running out of time, but we haven't spoken of one segment, which is electric vehicles. You're ending the year with 55% market share, but that segment saw hyper competition in the 12 to 20 lakh mark, where your market share is around 30 to 35%. How do you plan to revive that, and are there enough products coming in your portfolio in this year to plug those gaps?
Sorry, what's the consumer like there as well? Is there a second car that people are purchasing as an electric? Because that's something that we've seen in electric scooters as well, not comparable. But the 12 to 20 lakh range has gotten hyper competitive, but based on India's
so I think it's a mix of play. Let me answer both the questions together. Let's start with the customer. It's always a better place to start. I think we are finding first purchase coming into the EVs directly, but that has slowed down compared to what it was in the past. At the same time, second car is now becoming very much a par for the course in terms of people picking up the second EVs there. But if you look at tier 1, tier 2 cities, it's becoming the first car itself. But park that point. I think it goes back to the other point that is there. which is how do you step up penetration of EVs in the overall port? That's a big question to answer. I am absolutely relaxed as far as competition is concerned, because more competitive is good for the market in terms of, but the game is not about market share. I kept seeing it from day one, even when we are 85% share. The issue is about how do you drive penetration of EVs. And today the market is only 2.3%. If that has to go to 30%, you will soon find people have no choice but to push EVs onto just from a Cafe 3 perspective. Park that also aside. We have a full range of portfolio coming in. And we are the only player who starts from an 8-9 lakh car all the way up to a 25 odd lakh car. Then that will go with Avinya coming in, it will go even higher. So we have enough product introductions coming through there. The segment that you referred to, I think Nexon itself is now starting to go very strong post the relaunch. Then on top of it, you have the Harrier EV coming in. The Curve has just been launched in that same price segment. Then you have the Sierra coming in. And then the Harrier EV is there. So there's enough and more products available for us to play the game. I think our job as a market leader is to continue to drive mainstreaming of EVs, for which focus on chargers, focus on range, focus on put on price. This combination will then get cracked. So, and with the fall in battery prices, one of the things that really confused the market last year, and normally it happens in markets when price corrections happen sharply, is people just wait. I think now prices have stabilized, the confusion of hybrids is gone, and then suddenly you realize that the market is starting to come back again. And more competition means that the conversation also starts moving into EVs, then may the best player win.
You know, last time when we spoke to you, you spoke about the fact that there is the differential is going to come down and going to. Are you seeing that?
Already, Curve is matched, right? The Curve ICE and EV prices are matched. So the matching of it particularly happens in the higher end segment, because then the GST difference is also substantial. So we are able to pull it off even easier on the higher segment. But even in the lower segment, if you look at the TCO perspective, EVs are comfortable in that respect.
Because maximum volume comes in that segment, 12 to 20. So you're seeing that happening there also, right? Balaji, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.
My pleasure. Thanks for having me on the show. Take care.